All right, welcome everyone to today's session on goal setting for sales teams. So for those of you who are new to my webinars, this is the flow for tonight's session. We'll kick off with some quick introductions, then we'll jump right into the presentation, and we'll leave some room throughout the presentation and at the end for Q&A as well. So if you have any questions at any time, feel free to type in the chat, or if you're on Facebook, just feel free to make a comment on the video and I will be checking as well. And I will try to answer the questions as I do the presentation, but I'll leave some room at the end as well. And we should be able to wrap up at 7:30 p.m. on time, if not earlier. So let's get to it. My name is Chin. I'm your host tonight. I run this company called Classy Now. To give you some of the background, I come from a background of both entrepreneurship and corporate. So I've been spending the last 5 years in the startup ecosystem here in Vancouver. I work for a startup incubator accelerator that focuses on social ventures. During that time, I probably worked with and supported about 500 different entrepreneurs. And in the work that I did over there, I was primarily supporting them with growth. So growth on how to grow the team, but also sales, increasing revenue, optimizing your processes. Prior to that, I spent about 4 years or so in corporate. Mostly in the telecommunications industry. So I was doing a lot of B2C and B2B sales. So what I hope to be able to share with you tonight is some of the best practices from corporate, but also some of the great and creative insights that I've been learning from a lot of the entrepreneurs that I've had the pleasant opportunity to work with. So these are the key 3 things that we'll be covering tonight. First off, I want to talk a bit about financial modeling, both from the top down and from the bottoms up. And then we will dive right into the goal setting aspect, which is what you all are here for today. And then we will wrap up by talking about how to measure the right things, looking at the right metrics, making sure that you're actually tracking the right behaviors. And lastly, how do you motivate and incentivize your sales reps to continue to perform? So first off, let's talk about forecasting. So forecasting is typically most important in the planning stages. More so, especially if you're an early stage entrepreneur and if you're planning on raising capital, you'll tend to notice that you will be using some form of forecasting when you're talking to an investor about your market or about your potential. When it comes to forecasting, the standard template is to do what we call a top-down market size. When you're doing a top-down projection, you will hear terms like TAM, SAM, SOM, and PM. What it stands for is TAM is total addressable market. So you might say, oh, the education market is a $6 billion industry. So that's TAM. Service attainable market is the small portion that you think you are able to service. So you might say, oh, we are actually just focusing on the education market in Canada. And that is a $12 million industry, for example. And then you might say service obtainable market. So obviously you might not be able to capture the entire Canadian market. So what is realistic, considering competitors, considering what you think you can penetrate? So you might say, oh, we think that we can capture 5% of the market, for example. So it really depends on your technology and your industry. You might be able to capture as little as 5%. You might be able to capture more than that. And the penetrated market is what do you already have? What have you already penetrated? So you might say, oh, we already have 20,000 a month in recurring revenue. So that's where we are in penetrated market. So the challenge that I find with top-down market sizing is that when you do it this way, almost everyone will try to create a financial model that actually looks like they have a really, really huge market. And the problem there is it's very easy to trick yourself into doing that because if you pick a big enough market, it's always easy to fool yourself into thinking that you're being conservative. You might say, oh, we are only capturing 1% of the market, right? But if you can say something like, I can sell Coca-Cola to 1% of China, I'll be a billionaire. But can you actually get that 1%? 1% might sound like a very small number. It might sound like you're being really conservative, but in reality, that's actually possibly not even something that you can actually do. So as an alternative, the other option is to do a bottoms-up projection rather than a top-down. So this is one example of how it might look like. So you might say there are 600,000 dogs in New York City. And we know that 8% of those dogs are walked every single day. So that means that the number of dogs walked per day is 48,000. And if we are charging $20 as the rate to walk a dog for 30 minutes, so we think that each day we can make 960,000. And then from there, each year, basically we multiply that by the amount of weeks in a year. So that brings us to $149 million. And we think that we can actually capture 5% of that market on a 4% commission rate. Therefore, we think that every year we should be able to at least make 299,000. So again, this does, it is somewhat similar to the top-down in the sense that the percentages that you're trying to capture, it is really arbitrary and it's really all guesswork at this point. But if you notice over here, you're actually starting from the bottom, you're starting from the number of dogs instead of going on the top and looking at the market size, the industry size, right? So that's one way of doing a bottoms up. The other way of doing it might be something like, you might say, oh, right now I can make 10 calls a day. And out of the 10 calls, I will close 2 sales every single day. Therefore, in a week, that allows me to close 14 deals. And in a month, that equates to 56 deals a month and $4,000 in revenue. So you might do it bottoms up that way. And then you might say, oh, if I'm able to hire 2 salespeople, that allows us to create scale revenue by double the amount or triple the amount, because now you have 3 salespeople, right? So the idea here is if you're doing bottoms up, what you're trying to take is you're trying to take a more operational perspective to financial modeling rather than looking at a market size. And if you do it correctly, your top down and your bottoms up should align. If it's not aligning, you're probably not being realistic with your top down. So that's just something to bear in mind. So let's look at goal setting then. So this is an example goal. So if you might say that your goal is to hit 200,000 in revenue in the next 12 months, right? So 200,000 in revenue, 12 months, and your price per unit for your product is $500. So here you can see that sales required is you just take the total revenue, you divide that by 500. So that means you need to sell 408 units. Make sense? So let's break that down into a funnel, and then we can see how the goal setting piece falls into play. So if you have a funnel, and this is one example funnel, this might not be the exact funnel that you will use for your business, but I just want to walk you through this example so you understand the logic behind it. So if you have a funnel that is ad views that go to a landing page, that go to a webinar, and then people attend the webinar, they book a strategy call, and then they close, right? So now you know that you need to close at the end of the year a total of 408 units of your product sold. And assuming here you predict or you know that your conversion rate between a strategy call to a closed customer is 60%, that means you need 680 strategy calls booked for the total year, for the whole year. And then you're working backwards, right? So for the webinars, 20% convert to a strategy call. So therefore, you know that you need to have at least spoken or have had 3,400 people attending your webinars over the entire year. And then again, you go backwards. So registration to attendance, what is the attendance rate? Typically 50%. So you might say, oh, we need at least 6,800 registered. And then you go back again, landing page views to registration. So that means you need at least this many views on your landing page. And then same, let's say if you go from ad view to landing page click-through rate. So that means maybe you need 3 million views on your ad. So the idea here is if you work it back this way, it really gives you a sense if your, number one, if your conversion rates that you estimate, are they accurate? And is it actually feasible and possible? Of course, you might make some mistakes. You might not actually have it work out the exact way that you plan. So assuming over here, registrations from webinar to attending, I mentioned 50%, but let's say it's actually a lot lower than you expected. And only 20% of the people who register end up attending. Then you'll know that what will happen is everything upstream gets affected, right? So you actually need more people to register for your webinar now in order to hit the same number. And therefore, you also need more people to come to your landing page, and you also need more people to view your ads. Make sense? So if results don't turn out as expected, then you know what to adjust and you know what's wrong in your funnel. The opposite can also happen, right? Let's say if it's better than expected. So if it's better than expected, instead of 50% people attending, let's say 70% of the people actually attend, then what happens then is everything downstream is affected. So you can actually exceed your target. That means the more people will actually attend the webinar, more strategy calls will come out of that, and more people will close. So number one, it could be great, you exceed your target. Or number two, it might mean that you don't have to stretch as much to hit some of those kind of top of funnel targets. This is where it gets a bit fun. So now you know your sales targets in order to get the revenue that you're looking for. What you can then do is you can try to divide the time up and try to think and plan for your team. So for example, over here, you might say, oh, for each customer that we close, we would typically spend about 2 hours with them. So that's including servicing time and customer service. And let's say strategy call is usually half an hour per customer. And then these are some of the other ones that are a bit harder to figure out. So webinar attendance, registration. So these kind of things, you might actually try to divide that up because it usually happens as a bulk amount of time that that goes into planning upfront. So you might find that, let's say, setting up the landing page, setting up and planning for the webinar, and actually facilitating a webinar, that's a lot of upfront work. So you just try your best to divide that amongst the number of customers and try to get an estimation. So you might say, okay, you know what? Maybe it's about 20 minutes that is usually spent per customer for each webinar, right? And then same with the registration. Maybe it's only like, what is that? 10 minutes? Oh, sorry, no, that's probably only 10 seconds. And then landing page views. So the idea is you try to move the numbers around. But once you have a rough idea here, then you can actually calculate the total hours that you spend in each area of your funnel. So over here, you can see 2 times 4, 8 equals 816. That means each customer, sorry, for all your customers, in order to service the 408, you will need to, over the course of the year, spend 816 hours with your customers in the close stage, right? In the strategy call, this is the number of hours over here. And then you can see basically everything here, you basically multiply hours per customer to your total. That's how you get the total hours. And then if you want, you can divide that per month. So what you're looking at here on the top is number of customers that you're trying to get each month instead of over the entire year. So then it also helps you see, like, if you're actually getting 34, did you actually get to 34 this month? If you didn't, it means that next month you need to actually get more customers. Or if you exceeded 34, it means next month you don't have to aim as high, right? Or you can exceed your target. And then the same here, hours per month. You're basically just dividing your total hours over 12 months, and that's what you get. And when you can see it on a monthly level, this is where it becomes useful and helpful for you to plan for your team. Because then you know, okay, let's say on a monthly level, if you break it further down to each week, 40 hours a week for one single employee. So you can see, let's say over here, for each week, you have 17 hours that is spent on servicing the customer, 7 hours on strategy calls, about 14 hours in facilitating webinars. And the amount for registration is negligible, but then you're also spending some time on marketing, right? That means that you're actually managing your ads, running different campaigns, tweaking and optimizing your landing page, things like that. So you can see over here, these numbers might not be realistic, but this is just an example. So based on this, what you're seeing then is you see your final hours each week, and it will actually tell you that based on this, you probably could get away with one full-time employee that's actually managing both the servicing aspect of the customer and also the closing aspect. So that's dealing with them, converting them from the webinars, doing the strategy calls. But over here, you can see that it actually means that you need probably 78 full-time marketing employees in order to service that 283 hours that you see over there. So if that is the case, then it means that you are a marketing heavy company. And that might or might not be what you're aiming to go for. In this case, it's fairly realistic to make this assumption because with a product that's valued at $300 per product, typically these type of businesses will be focused more on marketing rather than sales. So again, there's no surprise. You're seeing a more marketing heavy team build rather than a sales heavy team build. Of course, if you have a much higher product value, then what you might see is that the funnel might look completely different. It might not be a webinar funnel. It might be actually a cold calling funnel, right? And the number of hours are all going to be different. And it means that you probably just need more sales reps in order to hit those targets. So of course, there are certain assumptions over here. The assumption is that a full-time employee works 40 hours and a part-time employee is anyone who works for less than 40 hours a week. So this just helps you plan both for your financials for your business when you're actually trying to do your annual projections. It helps you also understand like what your team is going to look like and whether or not it's possible to scale at the pace that you're aiming to scale at. So let me check any questions so far. If no questions, I can quickly move on. Great. So let's talk about metrics then. Metrics, when it gets to what to measure, I would say keep it simple. a lot of people try to overcomplicate metrics. And these are the main things that I like to look at. So top of funnel, number of new leads coming in. You want to know average time to close a deal, because that will actually give you a picture of the length of your sales cycle. You want to know what the conversion rate is. And when I say conversion rate, it's between each stage. So whether or not it's number of emails sent to number of emails replied, maybe it's number of emails replied to number of meetings scheduled, and then from meetings scheduled, number of demos, and then from there, number of customers that convert, right? So what are the conversion rates at each step and each stage? And you're basically assigning quotas and targets to each of them. So on a high level, that's how it is. If you're really struggling to come up with the right metrics to measure, this is one way you can think of it. So this is the Pirate Metrics framework introduced by Dave McClure from 500 Startups. And it's called Pirate Metrics because it stands for AARRR, like R, like a pirate. So the first A is acquisition. So acquisition is your number of customers that you are acquiring, getting to you. So that could look like the number of people who sign up for your webinar, right? It could be the number of people who click on your ad. So what is the acquisition metric there? Activation. You might be really good at marketing. You might be really good at getting the customers, but will they actually convert into becoming a customer? So that's activation. And activation, there's usually base level activation, and there's usually more of what I call long-term activation. So base level activation is when they actually create an account, for example, or if they sign up for your product or service. So that's your base level activation. Do they actually join? Do they actually want to use your product? Do they download your app, right? And then your higher level activation or your long-term activation is when you actually see that they exhibit a behavior that indicates that they will become a long-term customer. So for example, Foodie, which is a Vancouver-based company, they do food delivery service for businesses. So they do business catering. For them, first activation is, do customers actually create an account? And then the second level activation that I'm talking about here is, if a customer makes 3 or more orders on their platform, they know that this customer is likely going to be a long-time customer. So what they do then is they try to optimize to encourage the customer to make at least 3 orders. So if you know that that is the activation point that gets your customer across the line to become a long-term customer, to become a loyal customer, what are things that you can do to incentivize them to actually cross that line? So maybe they are giving discounts for the first 3 orders, for example. So that's one way of doing it. So that's activation. Revenue then. So how are you tracking revenue? Is it your lifetime value of your customer? Is it your monthly recurring revenue? So what is the number over there? And then retention. How sure you might be really good at getting customers. Customers are paying. But if your customers only stay for 2 weeks and then they uninstall your app, or if they only make 1 order and they don't use you again, that's a bad indicator. Because the idea over here is you want to make sure that your lifetime value of your customer, or your LTV, exceeds your CAC, or your cost of acquiring a customer. Basically, in a nutshell, for every customer that you get, if you're spending $5 to get a customer, you want to make sure that you make more money from the customer than you actually spend to get the customer. So your LTV, your lifetime value, has to be more than $5 to make sense, right? It has to be at least, I recommend at least 2x. Usually a good number is 3x or more. And then lastly, referral. Sure, you're good at getting customers, they're staying around, but referral is a great number to look at, because if you have good organic referral, it's an indicator that, number one, your product is valuable to your customer, but not only that, number two, your company will grow organically, even if you don't spend any money or budget on marketing, right? So if you can try to measure referral, try to determine and assess if that number is a good number. And the way to measure that is what we call the Net Promoter Score. So that's where you see those questions where they ask, on a scale of 1 to 10, how likely are you to refer our product or service to a friend? And if the score is a 9 or 10, that means it's positive. If it's 7 or 8, it's neutral. And if it's anything less than a 7, that means it's actually a detractor. These people will actually not refer you. They'll actually tell people to stay away from you, right? So these are the high level metrics. You don't have to have too many metrics. I would say pick one for each category, right? So acquisition could be, let's say, number of registrations for your webinar. Activation could be a number of people who sign up for a demo. Revenue could be a number of, it could be monthly recurring revenue. It could be lifetime value of your customer. Retention is your churn. So how many customers leave every month? And then referral could be a Net Promoter Score. So you could keep it as simple as that. If you are at least tracking on this high level, then you will at least know where to start when things go wrong. So if you're noticing that you're having poor acquisition, then you can dig deeper. You can find out what's going on. Is it that your ad conversion's not working really well? Is it that your landing page view times are too short? Is it your bounce rates are poor? So you can start to dig into that if you know what the high level metric is. So I'd say if you're starting out, don't try to overcomplicate it by trying to track everything. Just think, what are the high level metrics that I want to track for each of these categories? And then you can start to drill down if you need to. The key thing I want to remind you of at this stage is the challenge when it comes to metrics and goal setting is a lot of the times we tend to fabricate goals that are artificial. So what I mean by that is when you have goals that are monthly, that are annually, that are quarterly, these are business goals that we try to set a framework around because we just need some measuring stick to say, okay, at this time, have we hit our target? But you have to remember, if you really think long-term, you're thinking about a business that exists indefinitely. And businesses don't plan on necessarily a 1 year or quarterly basis because certain things just happen ongoing, right? And we've seen that a lot this year with how COVID has affected a lot of financial plans, a lot of business plans. People are having to readjust all of their projections and just do things on the fly because in a perfect world, things don't actually go according to quarters and months. So the idea here is when you're setting your goals, they help, but don't be overly committed to those goals because you want to be able to adjust those goals based on what you see is reacting and happening around you. So I'll give you an example here. And this actually comes from one of the talks that Simon Sinek gave. And this example will really help you understand the difference between really understanding short-term goals and long-term goals. So over here, you have two teams. You have a sales team, team number 1 and team number 2. So hypothetically, let's say team number 1 has a toxic culture. They have a bad manager. They tend to be hyper competitive. They tend to steal sales from each other. They're doing deep discounts in order to meet their targets. They're a bit manipulative. They sometimes kind of come across as scammy to their customers, and maybe they're pushy. They push customers to close. And if you're working in team number 1, there's poor team morale, poor retention. People are turning out all the time. And let's say, for example, you have team number 2, on the other hand, they're exhibiting all the right behaviors. They tend to be a positive team. They work well together. They have a good manager. But what happens is you set a sales target for both of the teams. And you find that team number 2, they have slow and steady growth. They're trending the right way, but they fall slightly short of that goal. And if you just purely focus on the goal and you're not looking at behaviors in the team as well, and you incentivize the team that hits the goal, let's say team number 1 is able to hit the goal, and they hit the goal because they do deep discounts, they're pushing customers to sale, to buy. And if you reward team number 1 for that behavior, then you're basically sending out the message that do whatever it takes in order to hit the target at all costs. We don't really care how you do it, right? And that can be dangerous. So if you're managing a team here, you want to make sure that you are mindful of that, because how you get there matters just as much as when you get there as well, because the how will really determine the culture that you'll build in your company. So ensure that you're rewarding behaviors that align with your organization and your personal values, not only just rewarding purely based on whether or not someone actually hits the target. Make sense? The other thing to remember as well is the difference between intensity versus consistency, which is kind of suggested over here. So typically we will favor initiatives, ideas, or projects that are intensive because they tend to generate very visible results. For example, you might say, oh, we'll run a big campaign, there's a big competition, and we'll push to get to $200,000 in revenue in the next year, right? So it's an intensive thing. But the thing is, intensive projects, they tend to give you very visible results, but they tend to be very short term. On the other hand, there are certain things and behaviors that are more long-term that will actually create compounding effects and big results, but you don't see them in the short term. So for example, if you think about going to a dentist as an example, we all go to the dentist and we know that it's important to go to a dentist. But if that's all we do, if we only go to a dentist, all our teeth will still fall out, right? On the other hand, consistency, like brushing your teeth, takes you maybe 2 minutes each time, right? And you brush your teeth twice a day. That's something that's really small, that doesn't actually give you clear results at the end, Like if you stop brushing your teeth, you miss brushing one time, it's not a big deal, right? But if you only focus on intensity, if you only go to the dentist and if you don't brush your teeth, obviously something's going to go wrong with your mouth. On the other hand, like if you're consistent with brushing your teeth and you do it every single time, then you know that you will actually end up with healthy teeth at the end of the day. So it is important to also focus on rewarding those consistent behaviors that are positive behaviors, not only focusing on the intensity aspect of things. So that's it. How do you tie it all together? How do you tie your goals and the right behaviors together? I think OKRs is a great framework for that. So I know Rob from 7 Geese, they are very familiar with OKRs. And I love OKRs because how it's done is you set your objectives and then KR stands for key results. So this is one hierarchy of an example, one example of a hierarchy. So you have your ultimate objective or your mission of your company. And then you can have your company objective, which is a more specific, tangible operational objective. And then below that, you have group objectives. So maybe you have a marketing department objective, you have an objective for your sales department, you have a different objective for your product department, right? So you can have different objectives, but once you set on the top down, if you set clearly from the top what your ultimate objective is, for example, we want to reduce plastic pollution, and what are the key results? So you might measure, okay, to know that we have successfully reduced plastic pollution, we want to have diverted, let's say 700 kilograms of waste from the landfill every month, right? So what are those key results there? So objectives, key results, and then you have underlying company objectives that help you work towards those main ultimate objectives, and then same with your group objectives as well. Then what will happen is you will organically create an environment which creates a pull system where people will naturally want to actually come up with their own goals. So you don't actually need to set the goals. You'll just set the objectives. And then you let your team, you let your employees actually define what their objectives are and what key results they want to use to determine if they've hit the objective. And then you let them come up with the initiatives. So if you do it that way, then you'll actually design an environment or a team or a culture where people are excited about the work that they do, and they can actually feel like they're positively contributing towards the goals that you set in a meaningful way, using the right behaviors. So it's not purely about hitting those targets. So the key results are there. You still have those numbers, those metrics that you need to look at, but you let them define what initiatives they use and what are their personal departmental objectives. So here's an example. So objective is delight our customer. Key result means that we want to increase average weekly visits to 3.3 per active user, or we want to reach a net promoter score of 52%, or we want to increase non-paid organic traffic to 80%, right? So these are some example key results that help you measure if you've hit your objective. A good objective is typically inspirational, and it's usually not measurable. It gives you a direction, but it doesn't actually put a specific number on it. A good key result, on the other hand, is measurable. It helps you measure and tell if you've actually successfully hit or defined that milestone there. So usually it's ambitious, but not unachievable. And the last piece is, as you start to implement OKRs, as you start to get your team to work, you want to make sure that they're actually taking the time, maybe it's a monthly check-in, maybe it's a quarterly check-in, to implement mindfulness. Because what happens is when you are mindful, when you take the time to reflect, that's when you know, like, are the behaviors actually positively contributing towards hitting your goals? Because some of these things, like I mentioned, they don't generate immediately visible goals. So you want to be mindful, you want to allocate time to reflect to see if it's helping you trend towards the right way, or if it doesn't actually help you move towards the right direction, right? If it doesn't, then you know that you need to change something. The last piece I'll talk about is incentivizing sales reps. So typically most companies, what they will do is they will implement a commission-based incentive. So commission usually looks like, if you hit a certain target, you'll get paid out. The challenge with commission-based incentives is that they tend to put a blinder on your rep. It works very well if you have a sales process that is already proven to work, but it actually limits creativity. What I mean by that is, When you have commission, people will focus on doing the same thing more quickly, more efficiently. They will stop exploring other new alternative options. So I'll talk about how you can motivate them in another way. But if you do decide to do commission, if you already have a process that works really well, then my recommendation is, number one, don't call it commission. I like to call it revenue share, because when you say revenue share instead of commission, people feel like they have a vested interest in getting this revenue together because they're sharing in it with your company. The other way is try to avoid pure commission. Try to have some base and the revenue share, and also don't limit the amount of revenue share. So what I mean by limit is, if you really want your reps to exceed your target, you don't want to say, oh, you're maxed out at, let's say, 2,000 in commission every month. Don't limit it that way. You can limit it in a different way. So you can say, oh, we'll split revenue. For every sale that you close, you get 10% of the revenue over the next 2 years, for example. So that's one way of limiting it. Or you could say, you get 10% of the sale that you close, and then you get a trailing retainer fee, or sort of recurring commission that comes out over the next 2 years, which is, let's say, $5 a month per customer, for example. So if not commission, what is the better alternative? So this works more for if you are working with an early sales team or an early sales process where you don't really know what's the right way to close your customer, or there might be multiple ways to close your customer. So the better way to actually motivate them is through autonomy, mastery, and purpose. People tend to want to have the freedom to try different things, experiment different things. Give them that freedom, give them the chance to actually try those things. Mastery, people want to feel like they're improving. They want to feel like they're getting better at something. So if you can create some sort of, let's say a mentorship program in your company, that might help. Or maybe you can help compensate them for training programs that they take. And then lastly, they want a sense of purpose. So how can you tie what their actions are back to the company mission and goals? How can you give them a sense that they're not just another cog in the wheel, but they're actually positively contributing to this purpose? So if you can relate revenue to, let's say, what impact you're creating in your company. So if you're not a social venture, then I definitely challenge you to consider this. I believe that every business can be a social venture in some way. So how can you talk about this in the terms of how you're benefiting your customer? What is the value that you're adding to your customer? So for example, oh, this year we were able to divert, like I mentioned, how many kilograms from the landfills, or we were able to save X amount of time for all of our clients, right? So how can you quantify some of this value that you're creating? So that gives people the sense of the purpose. So kind of to sum it all up, number one, ensure that your growth targets are realistic and that you have the necessary resources. So if you remember, if you chart out your funnel like I showed you, it should help you understand if they're realistic, especially after you start to implement and test it. And then even more, when you start to put down the hours, it will help you understand if you actually are able to actually meet those targets. Do you have the right resources? Might you need to hire people? Might you need to actually change how you're doing marketing? Maybe you need a different channel. When it comes to metrics, number two, focus and keep it simple, stupid. So that's KISS. So don't try to overcomplicate metrics. Just track the high level. You can dig deeper if you need to. Because I think there's a quote from Mark Twain, data is like garbage. If you collect them and you don't know what to do with them, then you just end up with a lot, like this whole pile of rubbish, right? So make sure you know what you want to do with your data before you start to collect it. Lastly, when you're thinking about metrics as well, the how matters as well. Not just whether or not you hit it. So make sure that people are putting forward initiatives that align with the values of your company, that are ethical, that are things that you are comfortable with. And to motivate them, think about autonomy, mastery, and purpose. So that's basically it. I really went through it quite quickly. But yeah, if you have any questions, feel free to jump in. You can also send me an email if you have questions, and I'm happy to answer it. I have another workshop coming up on December 16. This is a pre-recorded webinar on revenue and growth optimization. So definitely check it out. You can visit classynawal.eventbrite.com for more details. And here's my contact. If you need anything, it's Chin, CHIN, at classynawal.com. So just send me an email. You can also connect with me on LinkedIn. And otherwise, have a great evening. I hope you enjoyed this session.